This is Nightly Business Report with Tyler Matheson and Susie Garrett. Brought to you by
TheStreet.com. Interactive financial multimedia tools for an ever-changing financial world. Our Dividend Stock Advisor guides and helps generate income during a period of low interest rates. Real Money helps you think through ideas for investing and trading stocks. Action Alerts Plus is a charitable trust portfolio that provides trade-by-trade strategies. Online, mobile, social media. We are TheStreet.com.
Nerve-wracking day. Investors dumped stocks, then bought them back. Amid all the volatility, what should you do, if anything?
A bright spot? Shares of Hewlett-Packard have their best day since 2001. But you may not want to call it a comeback just yet.
And hurricane warning, are businesses prepared for what's predicted to be another active storm season? All that and more tonight on Nightly Business Report for Thursday, May 23.
Well, volatility was the word of the day on Wall Street. Investors were pessimistic right from the opening bell, rattled by a big stock sell-off in Japan, a weak economic report in China, and lingering jitters about Federal Reserve policies undermining U.S. markets. The Dow tumbled triple digits, then rebounded thanks to encouraging news about housing and the job market. By the closing bell, the Dow lost only 12 points, the Nasdaq slipped about 4, and the S&P was down by 5 points. Here's Bob Pisani with a tick-by-tick look at what drove today's wild swings in the markets.
It started out wild, and it ended on the quiet side. The Dow dropped as much as 115 points right after the open, but rallied in the next 2 hours and went positive on several occasions before ending fractionally in the red. With worries about higher interest rates down the road, interest rate-sensitive groups like utilities and REITs, real estate investment trusts, were weak again today. Another problem, weakness in manufacturing in China caused the Japanese stock market to drop 7%, its biggest drop since the tsunami 2 years ago. China is a critical market for many U.S. multinationals. One big help to the Dow, Hewlett-Packard, up 17% to a 52-week high as the company implied business was stabilizing. They raised guidance. There was heavy volume at the open for the second day in a row, but heavy selling was met with an almost equal amount of buying interest, a sign that despite worries the Fed may end its bond buying program, there's plenty of people who don't think it will happen anytime soon. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
As Bob said, one of the fears hanging over stocks is that the Federal Reserve, sensing an improving economy, may slow its bond buying program. So the question now is good economic news suddenly bad for the markets? Kelly Evans takes a look.
The U.S. labor market is improving. New claims for unemployment benefits fell by 23,000 last week, and the total number of Americans on jobless rolls is back below 3 million for the first time in 5 years. Good news, right? Not so fast. Stock market futures took a hit this morning after that report. New home sales and prices beat expectations, but the market shrugs it off. These are just the latest examples of what's become the new normal behavior on Wall Street. Stocks now seem to sell off every time we get better than expected reports on the U.S. economy, instead of cheering the news. So what's going on? Shouldn't investors bid up stocks on the prospect of better future earnings and revenue growth?
Not right now, because there's more concern about how the economy will do if the Fed begins to taper its $85 billion a month in support. In fact, markets tumbled globally yesterday after Fed Chairman Ben Bernanke told Congress the Fed could begin to dial back as soon as this summer if the labor market improves.
We're trying to make an assessment of whether or not we have seen real and sustainable progress in the labor market outlook. And this is a judgment that the committee will have to make. If we see continued improvement and we have confidence that that is going to be sustained, then we could, in the next few meetings, we could take a step down in our pace of purchases.
After those comments, U.S. markets turned negative, and it was a sea of red across Asia and Europe as well. For one, investors are worried that the U.S. economy isn't strong enough on its own to justify stock market prices this high. For another, the prospect of higher interest rates without the Fed's bond buying is spooking concern as well. Still, some investors saw the early sell-off Thursday as a buying opportunity, and that helped the Dow rebound from triple-digit early morning losses. Perhaps it also helped that a gauge of U.S. manufacturing activity separately fell to an 8-month low. The message? The U.S. still isn't strong enough to stand on its own two legs. And that bad news, for now, is seen as good news on Wall Street.
For Nightly Business Report, I'm Kelly Evans from the New York Stock Exchange.
So is now the time to change your long-term investment strategy as the data talk one way and then the other? We'll chat about that in just a few moments.
Hewlett-Packard knows about good and bad. Profits plunged 32% last quarter, but shares surged 17% today. The legendary company has endured management shakeups, restructurings, and financial ups and downs for the past 3 years. Now CEO Meg Whitman says HP is right where it's supposed to be. John Fort has more.
HP stock today reached 52-week highs after earnings showed a turnaround at the tech giant might be closer than critics thought.
So are happy days here again? Not so fast. These results are more a testament to CEO Meg Whitman's skill at managing expectations. Revenue actually missed consensus by $500 million as PC Group sales came in especially weak. But investors were more focused on non-GAAP earnings per share, which beat by 5 cents.
Beneath those headline numbers, it was a mixed bag. PC unit sales fell a whopping 21%, with laptops faring worst. In that department, HP made the opposite decision from Dell. HP chose to sell fewer low-end PCs in the quarter to boost profit margins. The server business suffered, down 12%. Printing, networking, and technology services held their own.
There are huge tectonic plate shifts about the way technology is consumed, the way it's bought, the way it's paid for, the way software is written and delivered, the way end users engaged with technology. So there's a lot going on in our world, but we are growing businesses that power the new style of IT. We've got declining businesses that powered the old style of IT. So we're in that knothole that one has to get through. But I feel good about the growth prospects for 2014.
And growth is where all of this hinges. PCs and printers now make up less than half of HP revenue for the first time in quite a while. If Whitman's going to deliver growth next year, she'll have to either figure out a successful tablet and smartphone strategy or a way to turbocharge the data center.
I think it's more likely that they have upside in data center because I do think that's where more of HP's strengths lie at this stage. And frankly, in the consumer side, they really haven't shown much to make one expect a lot of upside there anytime soon.
So it's not a turnaround yet, but it is discipline from HP's C-suite when it comes to managing earnings and setting investor expectations. Given HP's recent history, discipline alone is worth a little excitement. For Nightly Business Report, I'm John Fort.
Retailers' earnings, that's our market focus tonight. Let's begin by minding the gap. Gap stores reporting a 43% increase in profits, beating estimates while revenues were in line. The company's Gap and Old Navy brands did particularly well, but same-store sales were flat at Banana Republic. So shares did not jump on that profit news. After trading less than 1% higher during the day, they closed at $41.36. Sears also reporting after the close today and posting a loss of $1.29 a share. That's more than double Wall Street estimates. Declining same-store sales at both Sears and Kmart locations, blamed now on cooler spring weather. Sears shares had been on the rebound, up more than 30% for the year, but flat today, closing at $58.17 before dropping more than 10% later on that earnings news.
Dollar Tree was the top gaining retailer, reporting a 15% jump in profits and raising its earnings outlook for this year. The discounter also increased private label products and added frozen foods at some locations. Shares of Dollar Tree rose almost 4% to $50.19. And Ross Stores reported a 12% jump in profits and raised its guidance for the full year. Ahead of the report, this discount apparel and housewares chain announced a dividend of 17 cents. Shares were flat during the regular trading session, closing at $65 and change, but rose about 1% in after hours on that profit news.
So how should you invest in a market suddenly prone to wild mood swings? Here with advice is John Manley. He's Chief Equity Strategist for Wells Fargo Funds Management. Great to see you again, John. How are you?
Very well, thank you, Tyler. Good to see you.
Terrific. Is this what we're seeing in the last couple of days, the beginning of the widely expected correction that so many have been predicting for so long?
I've never seen a widely expected correction actually occur. I think this is a buying opportunity. I can't give you guarantees about 1 or 2%, but there's still a lot of money waiting to get in. The market still goes down very quickly on minor bad news, which says to me people are still itchy.
They are feeling itchy, and they're also very nervous. They don't like this volatility. So what should investors do, or maybe not do, during this phase of volatility?
I think not pay attention to the volatility is the best thing. Decide where you want to be in a year or 2 years, or how you want to retire. Set your portfolio up so you can afford to fund it. I think that's really important. Yield is a very, very important commodity going forward.
One of the things I noticed, John, in your sort of model portfolio is that generally as a baseline, you think 65% in equities is a good place to start, given the growth potential there. But as I understand it, you've got sort of 5% in cash and nothing in bonds, with the remaining 30% or so in what you describe as alternatives. Why no bonds, and what do you mean by alternatives?
Well, we're in the process of moving in that direction. We still have some bonds, but again, we're not going to focus on high-quality stuff. We're not going to focus on treasuries. There's just no value there. We think the spread product is very interesting at this point in time, but even that's not as cheap as it used to be. I think you need something to offset some of the volatility in stocks. I think more and more alternative investments do that, and we try to look at funds, for example, that actually do that sort of thing, that try and balance off the volatility of the equity market with a non-correlated asset that is not in the bond market.
Like what? Like what, John?
Well, there are a lot of things. You can do long, short. I think that's rather interesting. You can look at some commodities, both long and short again. There are all sorts of different little strategies that you can look at to try and get a little bit more than GDP, a little bit more than CPI for your return. And you get lower volatility in that part of the portfolio. You get lower returns. That allows you to stay more comfortable in the equity market.
Are there enough alternatives in that alternative space? Susie just asked you, like what? You mentioned long, short funds and some commodity. Are there enough alternatives out there, either in the form of ETFs or mutual funds, that are broadly available to individuals, as opposed to hedge funds that require that people be accredited investors?
They're out there. They're out there, and they are available to individual investors. I think you have to look a little bit, but they are there. I think one of the things that's happened has been the democratization of investing to a certain degree. It doesn't mean higher volatility. Hedge funds is there to hedge. Hedge funds are there to offset volatility, not create it.
John, you said that you're still a big believer in stocks. Tell us a little bit more of where investors should be putting their money, what kinds of stocks, and stocks that can withstand volatility.
I think that, well, first of all, we've been focusing almost exclusively on large cap for the last 5 or 6 months, and it's been reasonably good. I still focus on large cap, but I would be less strict about it, because I think you're going to see more M&A activity, and that's going to favor the mid cap area. They've been passed over to a certain degree. When it comes to sectors, I still think we're going to start rotating down towards more cyclical names. We'll hold on to the healthcare stocks for a while, because we think they do have decent value and they do have some growth, but it's more economically sensitive.
John, terrific. Thanks for stopping by. We appreciate it.
Great to see you.
John Manley with Wells Fargo.
And late this evening, NBC is reporting that the IRS's lowest learner, this is the woman who headed the unit at the heart of the scandal and who appeared in front of Congress yesterday, has been placed on administrative leave.
Coming up, a warning today that this year's hurricane season could be a quite active one. Are businesses prepared for what may be ahead? First, though, how the international markets closed today. Some of today's stock sell-off was due to weak economic data out of China. The fear of a slowdown there has money coming here. Despite negative headlines about Chinese investment in the United States revolving around security concerns, investment by Chinese companies in the U.S. is now at a record high and growing. Michelle Caruso-Cabrera has the story.
Vitamins of every shape, size, and solubility. Manufactured at this New Jersey-based company, but owned by Chinese investors. Next time you go to the movies, it may be a theater owned by a huge Chinese entertainment company. Driving over this bridge in New York State, it was rehabbed by a Chinese firm. Chinese companies spent $6 billion buying American last year, a record amount. The biggest investment so far, AMC Theaters. A Beijing firm called Dalian Wanda bought them last year for $2.6 billion. AMC CEO Jerry Lopez has gone from answering to American owners to answering to Chinese owners. He says regardless of nationality, the goals are the same.
They have expectations, as you would think, of net profit delivery and returns on investment and attendance growth. But those are not unexpected, nor are they, frankly, different than we would set on ourselves.
The chairman of Wanda, Jianlin Wang, tells me he's just getting started. He plans to spend another $7 billion in the U.S. before the end of the decade. He tells me the U.S. market is his top choice for investing, not only because it's the biggest movie market in the world, but also because the U.S. has the best environment for investors. The legal system here, he says, is more dependable than in many other parts of the world. Echoing that statement, Stephen Dye, CEO of International Vitamin Corporation in New Jersey, a firm he and several other Chinese investors bought in 2010.
So many good things. I encourage people to invest here.
They've poured hundreds of millions of dollars into IVC for expanding its IT system, warehouse, and nearly doubling the number of employees, all from the U.S. Dye also likes that corruption is nearly non-existent in the U.S. and that he's never been asked for a bribe.
You just focus on what you are doing, and your hard work will be rewarded. You don't have to deal with many other things like connections or relationships. This is it's a purely business relationship.
Nearly every Chinese executive told us the same thing. Ning Yuan is the CEO of China Construction America, building roads in New York State and schools in South Carolina.
Investment environment is very good here.
It's one of the key reasons why Chinese investment in the U.S. is expected to hit another record level this year. For Nightly Business Report, I'm Michelle Caruso Cabrera.
And AIG is waiting to hear if it'll be allowed to sell its aircraft leasing business to a group of Chinese investors. If so, it would become the largest Chinese acquisition in the U.S.
Hurricane season starts June 1st, and today government forecasters predict a stormy 6 months ahead. Insurance companies and businesses are already getting prepared, and the big question is, are you? Mary Thompson has more now.
Batten down the hatches, the National Oceanic and Atmospheric Administration warning the 2013 hurricane season could be a big one.
For the 6-month hurricane season, which will start June 1st, NOAA predicts an above normal and possibly an extremely active hurricane season.
Warmer than average sea surface temperatures in the tropical Atlantic Ocean and Caribbean Sea, along with near normal sea temperatures in the Pacific, behind that rough forecast. NOAA is predicting 13 to 20 named storms from June through November. It predicts 7 to 11 will be hurricanes, and 3 to 6 of those could be a Category 3 or above. This year's forecast above the average of 12 named storms and 6 hurricanes a year. As for insurers, despite a spike in claims expected from the thunderstorms and tornadoes hammering the Midwest over the last week and a half, analyst Randy Binner saying the insurance industry can handle an above-average hurricane season without a big Katrina-like storm.
The capital adequacy of the industry is strong, and it's very well positioned to absorb, anything but the very largest event. So a few hurricanes this summer really wouldn't make a lot of difference relative to the overall capital base of the industry.
As for homeowners, the Insurance Information Institute reminds you to make sure you have adequate coverage for your home. Flood insurance from the national program, as flooding isn't covered by most homeowners' policies, and an inventory of your valuables.
Lastly, for your own safety, have an evacuation route in mind if a hurricane is bearing down on your area. For Nightly Business Report, I'm Mary Thompson.
And for more on the business impact, we turn to Evan Gold. He's a senior vice president at Planalytics. Evan, I want to start by asking you to answer the question that Tyler posed. Are we better prepared for this hurricane season, individuals and businesses?
Hi, Susie. Yes, I believe that individuals as consumers we are, and there's a couple reasons for that. First and foremost, certainly the tragic events earlier this week in Oklahoma are a stark reminder that people need to be prepared for severe weather. And then certainly, the heels of Sandy last year that hit so many population centers that I'm sure on June 1st, the first day of the hurricane season is going to be a good reminder that folks need to stock up and get prepared. Next week is National Hurricane Preparedness Week, so hopefully people will be out there. From a business perspective, absolutely they are prepared. They've been preparing for a while, and the clients that we're working with are constantly prepared, right? These type of events, whether they're hurricanes, snowstorms, tornadoes, hail, you name it, they come at us and have come at us fast and furious over the last several years. So volatility is the word of the day.
We seem to get better forecasts of exactly where and when storms are going to hit and with what force. Comment on that, if you would, and how that helps people prepare better. And number two, are you expecting the kind of hurricane season, an active one, that NOAA is?
Sure, Tyler. So from a forecasting perspective, absolutely has gotten better. Not only better in terms of accuracy, but over time period, right? And today, looking at a 3 or 5 day outlook is a lot more reliable than it was just several years ago. So people have a lot more certainty. That doesn't mean you should get complacent at all, right? People still need to watch this and keep track and tabs of these events because, a little bit of wiggle, so to speak, for a specific track for a storm can mean significant impact to large population centers. In terms of the activity this year, you just mentioned that NOAA is looking to up to 20 storms. We're looking for an above normal season as well, maybe not that active, but certainly above normal. Now, again, on the heels of what happened last year, we only had a couple of major hurricanes, but everybody remembers Sandy, and really it only takes one event to have a significant impact.
You're absolutely right about that. So go over with us some of the mistakes that businesses make. What are some of the do's and don'ts for the companies that maybe are not so prepared?
Sure. First and foremost is be prepared, right? You've got to have a plan in place long before June 1st, including staging inventory, planning operations, planning logistics. All of those things have to be in place. I think the other thing to kind of keep in mind, especially from a business perspective, consumers buy on the forecast, not necessarily what actually happens. So if the news is out there saying that, 5 days in advance, there's going to be a major event, say, hitting South Florida, right, which is an area that's always under the gun and is again this year, consumers are going to be out there buying specific product. Whether that storm actually goes there or not, in some respects is immaterial because the consumers are already out there looking for it, and the businesses need to be prepared and serve as value-added members to those communities.
Thanks so much for all that good advice. Evan Gold of Planalytics. And still ahead on the program, there's a hot new job in healthcare, and it's one you probably haven't heard of. Find out who's in demand and how they're improving healthcare for everyone. But first, let's get a check on how commodities, treasuries, and currencies fare today. And finally tonight, hospitals, health insurers, and pharma are looking to harness big data, and the growth is pushing the demand for new skills like data scientists and analysts. One recent study estimates that by the year 2018, the U.S. will be short 2 million workers with the required expertise. In the last installment of our series on the future of healthcare, Bertha Coombs takes a look at closing that talent gap.
I think we've got the data grid covered.
It may not be long before Exploris outgrows its offices in Cleveland. The healthcare big data firm has doubled its staff to 100 in the last year, as its client list has grown more than twofold to 200 hospitals and more than a dozen health systems.
We've done very well at attracting great talent. I think that our mission and purpose is key. We've spent a lot of time really thinking about what matters to us. And our purpose is to really unlock the power of big data to improve healthcare for everyone.
But Exploris may be an anomaly. Competition for workers with high-tech analytics skills has been explosive, in part fueled by new digital billing and patient monitoring requirements for hospitals, doctors, and physician groups under the Affordable Care Act. Employment research firm Burning Glass found while total online job postings have grown a tepid 6% since 2007, and growth in healthcare postings has actually slowed to 5%, healthcare informatics job listings have surged more than 50% in the last 5 years. But a PwC survey found 2/3 of hospital executives say after building up their IT infrastructure, they're having trouble filling informatics and data science jobs.
50–60% of those CEOs are saying that they're concerned that they don't have the skills required to execute the strategy that they just created. And that's to me a signal that there's a real issue here.
But it's not just hospitals. Pharmaceutical companies, insurers, and researchers are all on the hunt for data scientists. A number of health services firms have resorted to buying the talent they need. In December, McKesson acquired population health specialty firm Medvedev for an undisclosed sum. In January, United Health Group subsidiary Optum bought clinical benchmarking firm Humedica after having acquired customer analytics powerhouse Connections in 2011. Could Explorus, with its growing network of clients, be next? Steve McHale doesn't rule it out. But either way, he's committed to working with others in the industry to nurture and help develop new talent.
We're involved in university programs right now that are forming both undergrad and graduate level informatics programs at a rapid rate.
Long term, that's the only way the industry will be able to fill the talent gap. For Nightly Business Report, I'm Bertha Coombs.
You know, Susie, in the movie The Graduate, Dustin Hoffman got the advice, plastics. The advice now is informatics and analytics, right?
A lot of jobs and people looking for jobs. I hope the ones who are in college will major in things so they'll prepare them for this.
And from that data, we may learn new ways of what really works, what the best outcomes are, and a way to lower costs in the medical care.
Let's hope for that. That's Nightly Business Report for tonight. I'm Susie Garup. Have a great evening.
And I'm Tyler Matheson from me as well. Thanks and have a great evening. We'll see you here tomorrow night.
Nightly Business Report has been brought to you by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our dividend stock advisor guides and helps generate income during a period of low interest rates. Options Profits helps educate beginning and seasoned options traders. Action Alerts Plus is a charitable trust portfolio that provides trade-by-trade strategies. Online, mobile, social media. We are TheStreet.com.
I'm Susie Garup with the Nightly Business Report News Brief. Wall Street was rattled today by a big sell-off in Japan, weak economic data out of China, and jitters about when the Federal Reserve will ease back on its stimulus program. But things leveled off following strong economic reports, including a decline of 23,000 first-time jobless claims last week and a spike in new home sales and prices in April. After a volatile session, the Dow lost only 12 points, the Nasdaq slipped nearly 4, the S&P was down by 5 points. Fidelity says 401k retirement plans have now reached a record high of more than $80,000 thanks to market gains. And government forecasters are predicting a stronger than normal Atlantic hurricane season with up to 6 major storms. Be sure to tune into Nightly Business Report right here on your public television station.